Hi everyone, this is Mrs. V Chan. Welcome to my Form 4 Foundation Accounting, lesson number 8. Today's lesson is about statements of financial position, or in the old syllabus, we use the name balance sheets. Okay, so here again we have the accounting cycle. Step number 1, journal entries, and then we do posting into the T accounts. And next we have the trial balance, and 4 and 5 are the financial statements or the final accounts. Now today's lesson is this number 5, statements of financial position. To explain to you what do we have in the statement of financial position, so we start with the accounting equation saying that A is equal to C plus L, and A stands for assets. Alright, and there are two kinds of assets. So one is called non-current assets, or another name is fixed assets. Okay, let me give you some example for this. For example, we have machinery. Okay, and then we may have furniture and fixtures, and then we may have motor vehicles. So these are the common examples for non-current assets or fixed assets. If you go to your textbook on page 130, you will find the characteristics of all these non-current assets. The first one, they are durable. That means they may be able to last for a long time and not being damaged. The second one, they will be used in the business for more than 1 year. And then the intention for buying all these non-current assets are not for resale. We have two kinds of assets. So apart from non-current assets, now we come to another assets, which are current assets. And here is the definition. Current assets are those assets can be converted into cash within 1 year. And converted means changed into cash. Okay, and we always have these 4 common examples. And then we start with inventory. And this inventory means the closing inventory, because these are the goods not yet sold to the customer, and then will be converted into cash. So how can we change or convert inventory into cash? Just by selling this inventory to the customer. Okay, and then the next one, trade receivable, same as accounts receivable, same as debtors, but usually in DSC we use trade receivable. Okay, and then how do we change trade receivable into cash or bank? We just receive money from the customer. And then next we have cash at bank, or simply bank. Okay, we just draw money from the bank and we get cash. So this is meaning of can be converted, means can be changed into cash within 1 year. And finally, the last item, we have cash in hand, or simply cash. Okay, so for the assets, we have two kinds of assets, so non-current assets and current assets. So after that, we come to liability. So here we have two kinds of liabilities. So they are non-current liabilities, and then another one is current liabilities. Okay, so what is the meaning of that? Non-current liabilities means the liabilities that have to be repaid after 1 year. That means we don't need to pay this liability in the near future, but the one that we have to pay in the near future, we call that current liability. So how near is that? Which is within 1 year, we have to pay this kind of liability, then we call it current liability. Okay, so for example, for these current liabilities, so we have this trade payable or accounts payable, which is same as creditors. Okay, so very often in DSC we use the term trade payable. All right, and then we may have this bank overdrafts. So what is bank overdrafts? That means when we have a negative balance in the bank accounts, this bank overdraft. So that means a negative balance in the bank accounts. And also this is a credit item when we have a credit side or credit balance, I should say a credit balance in the bank accounts. Okay, so for the assets, we have two kinds of assets, so non-current assets and current assets. So after that, we come to liability. So here we have two kinds of liabilities. So they are non-current liabilities. And then another one is current liabilities. Okay, so what is the meaning of that? Non-current liabilities means the liabilities that have to be repaid after 1 year. That means we don't need to pay this liability in the near future, but the one that we have to pay in the near future, we call that current liability. So how near is that? Which is within 1 year we have to pay this kind of liability, then we call it current liability. Okay, so for example, for these current liabilities, so we have this trade payable or accounts payable, which is same as creditors. Okay, so very often in DSE we use the term trade payable. All right, and then we may have this bank overdraft. Okay, so this bank overdraft means that when there is a negative bank balance, or which is a credit balance in the bank accounts, then we have a bank overdraft, and which is a kind of current liability. So therefore, if we go back to this current assets, we also have this cash at bank. That means if we have this cash at bank, which is the current assets, that means the bank accounts must be positive bank balance, and which is a debit balance in the bank accounts. Alright, so current assets. So we have this debit balance in the bank account, which is positive, and if the bank balance is a negative one, then we have current liability, and which is a bank overdraft. Okay, and also the example for this non-current liability, for example, we have bank loan. That means we borrow money from the bank, and then we do not need to pay the bank loan in the near future, and it would be a kind of non-current liability. Okay, so here we have a proper format for statement of financial position. We start with the name of the owner, and here is statements of financial position. And be careful how we show the date here, which is as at. That means, right, at 5 p.m. on this 31st December, how much assets do we have and how much capital and liabilities do we have? All right, so here the first half. All right, so this double line actually means the final answer for the first half of the statement of financial position. So which are two kinds of assets. They are non-current assets and current assets. And now we come to the second half. Okay, so we have the capital here, and then there are two kinds of liabilities, non-current liabilities and current liabilities. Okay, and finally, so this figure and this figure must be the same. Okay, as we always have the accounting equation saying that total assets equals to capital plus all the liabilities here. Okay, for example, let's say we have machinery. This is the figure for machinery, furniture and fixtures, and motor vehicles. So these are examples for non-current assets. They are durable, and they will be used in the business for more than a year and not for the purpose of reselling. So this is the figure for total non-current assets. Okay, all right, next, after non-current assets, we have this current assets, and we always have four common examples. They are inventory, and the inventory here is always the closing inventory. Okay, and very often we put this inventory in another column here. All right, and next we come to trade receivable. Okay, and then we have cash at bank. So that means when there is a debit balance in the bank account, which is positive. All right, and then we have cash in hand, like this. Okay, so therefore, if you add up these four figures and then we write the total here, so that means this figure is total current assets. And then we have this total non-current assets plus total current assets. So this figure means total assets. Okay, so we finished the first part of the statement of financial position. Okay, the second part of the financial position. Okay, so we have this financed by, we start with this capital. Now, if you look at the dates, 1st January 2019 to 31st December 2019, that means this is the opening capital. So therefore, this figure means opening capital. Okay, so after the owner has run the business for a year, and then the business makes net profits. And where do you get this net profit? Which is from step number 4, which is the income statement. So if you have in the income statement, which is a profit, which is a positive figure, then you have this net profit will increase capital. All right, and here drawings will be deducted from capital, means items taken away by the owner, so that you will get this figure. So this figure means closing capital. Okay, finally we come to the example for non-current liabilities. So we have bank loan here, and this is the figure for bank loan. And then 2 examples for current liabilities. They are trade payable, and this is trade payable. And then bank overdraft. So if we have a negative bank balance, so this is bank overdraft here, so that the total, this figure is total, this one is total current liability. Okay, and this one is total non-current liability. So therefore, the closing capital plus all the liabilities, so we get C plus L, which is the equation on the right hand side, okay, which is always the same as the assets being the equation on the equation, yes, on the left hand side of the equation. Okay, so therefore we can have another formula to work out this figure. This figure is closing capital, and which is equal to the opening capital plus net profits and minus drawings. So therefore we can go back to the previous diagram, and for this capital we have another formula, so to work out closing capital here. So closing capital is equal to opening capital plus net profit. So how do you get this net profit? You can refer to step 4, which is the income statements, and then minus drawings. Let's do one DIC question in 2012. Okay, here is to prepare the statement of financial position for Yip's business as at 31st December 2011. Okay, so we always start with the name of the owner, and then here is a nice statement. So statement, a nice heading, a statement of financial position, and always remember, so how we show the date, which is as at 31st December 2011. Okay, so we always have the first half to show total assets consists of non-current assets. Those are durable one, not for resale but for use in the business, and then the current assets. And the second half we have capital plus all the liabilities. Okay, so let's take a look at the questions here. So the items given to us, office equipment, what is it? Which is a kind of non-current assets. Okay, so trade receivable, same as debtors, so this is current assets. Okay, and remember, what about the inventory? Okay, so only closing inventory will be a kind of current assets, because closing inventory means the inventory not yet sold to the customer, but opening inventory already sold to the customer. So here, so in my statement of financial position, this inventory also means closing inventory, so which is 42,000. Okay, so now we have bank overdraft. What is the meaning of that? It means we have a negative bank balance, which is a credit balance as well, and that will be current liability. Okay, that is a special one. Okay, and then trade payables is a kind of current liability. And look at this loan from Sam's company, repayable in 2020, so which is not less than 1 year, so therefore it is non-current liability. Okay, so we can start doing this statement of financial position. For non-current assets, we have office equipment. Okay, so I get this 220,000. Okay, and current assets, the closing inventory plus trade receivable, which is 67,000. Okay, and then financed by here opening capital. So look at the dates. If this is closing 31st December 2011, so therefore this will be the opening date. So my date here is wrong. Okay, I have to change it to the opening dates. So that will be the beginning of the year. So that is 1st January 2011, and which is also given to us like this, where is opening capital. So here I have opening capital, here opening capital 231,000. So 231,000. Okay, now we come to non-current liabilities. That means the liability that we do not need to pay in the near future. So from the information here, we have loan from Sam's company. So I put loan from Sam's company. All right, so that is 38,000. Okay, and then current liability. So we have this trade payable. So where's trade payable? Here, trade payable, and also bank overdraft. So there are two kinds of non-current liabilities. So bank overdraft. So that is overdraft. Okay, and trade payable. All right, so how much is bank overdraft? So that is 17,600, and then trade payable, which is 26,300. Okay, then I need to get my calculator to sum up the figures. Okay, so in this question, we only have two kinds of current assets. So inventory plus 67,000, trade receivable, so that this is 109,000. This one is total current assets plus current non-current assets. Okay, so that the first half, I have 329,000. All right, okay, and then now we come to this opening capital, it's net profit. So net profit is not given to us in the question, and also net profit should be calculated in income statement. So since this is only 5 marks, so let's see whether we have another faster method to work out this net profit. Okay, let's work out that later. All right, let's look at non-current liabilities. This is the total figure, and then two kinds of current liabilities. Bank overdraft plus 26,300 for trade payable. So this is the total 43,900. So therefore, if we do not know this net profit, so we can use another way to work out this net profit. So because the total in the first half 329 must be the same as this total 329,000. Okay, so therefore this is 329. All right, so I can make it this way. I use the total from the first half to minus this, and then to minus this 38,000, so I get this figure 247,100. Okay, so in that case, we can work out this net profit in this way to save time, so that I minus 231,000. Okay, so that I get net profit as 16,100. Okay, so if we work out net profit in this way, very often we have a term to describe that. We call this figure as the balancing figure. means which is not given in the question. However, we work out that in this way from the accounting equation. Okay, so just now we work out this net profits, okay, from which is the balancing figure in the statement of financial position, and which is also 61,100. Okay, now we're going to prove it. Okay, so what about if we draw up and go back to step 4, which is the income statements? Okay, let's see whether we can prove this figure, which is also 60,100. Okay, so income statement, what do we start with? We start with sales. Okay, we do not have any returns inward, so we have cost of goods sold, opening inventory plus purchases less closing inventory. We do not have returns outwards. We do not have carriage in, so that's all right. So after sales, this figure for sales, which is here 109,000. Okay, so opening inventory, so this is 34,000. So I put this 34,000 for opening inventory plus purchases. So where's purchases after sales? 76,100, 76,100, and again minus closing inventory, so which is 42,000. Okay, so I use calculator. Cost of goods sold, opening inventory plus purchases minus closing inventory. So here, costs of goods sold 68,100. All right, and then we have sales minus cost of goods sold 109,000. Gross profits 40,900. Okay, so let's see, is there any revenue? So we have revenue. Discount received is revenue. So I have discounts received revenue, so 4,100. Okay, so therefore I get my total revenue of 45,000. So what's left? We have expenses. Let's check what expenses we have. Salary, rent. Oh, salary. This is expenses, expenses, and expenses. So all three kinds of expenses. And what about discount received? That is a kind of revenue. Okay, so therefore I have this three kinds of expenses: rents and rates, salaries, and other operating expenses. Okay, so rent and rates being 12,000, salaries 9,000, other operating expenses 7,900. Okay, so altogether total expenses, so which is 28,900. Okay, so deduct this from total revenue, so 16,100, which is the net profit. Okay, so done. Net profit from income statement, step number 4. We have 16,100, so we can prove. All right, so net profit here from the balancing, which is the balancing figure. All right, so we get the same answer. Okay, so therefore to work out net profit using balancing figure will be faster because we only have 5 marks to do this statement of financial position. Okay, so that's all about the DSE question in 2012. Thanks for watching my video. I'll see you next time. Bye bye.